Hi guys and welcome back, and in today's video we're looking at the Cakebox results. I always look forward to the annual results. I go through and analyze them, and I'm going to do the same today. Okay, so these are the audited full-year results for 12 months to the 31st of March 2023. What can we see in the headlights and the highlights? And there's going to be a lot more to go through here, so I'm just going to go through these, and I'm going to be referring to the highlights because it's quite important to not just look at them. Revenue was up 5%. Gross profit was up 8.5%. EBITDA, which is earnings before interest, tax, depreciation, amortization, which is basically net earnings, you can see it as, was down 24%. I'm going to look into that and find out why that was. Adjusted again was down. Pre-tax profit down 28%. Adjusted tax profit down 22%. Cash has gone up 11%. Earnings are down 30%. Dividend is up 8%. I'm going to have a look at why all this is. Operational highlights: growth in online sales 4% after 41% growth last year due to COVID restrictions. So there's still a like-for-like growth of 4%, which isn't bad. 20 new franchise stores open in the year, and the previous year was 31. So there's a slight drop off there. But in the other video I did recently, they said they've got, I think they've got deposits for over 40 new stores, I think they said. So that's still positive. They have 205 stores in operation as opposed to last year, which was 185. And they've got more kiosks. So they've got supermarket kiosks offering now. 18 is now in the supermarkets where there was 15. I think they could go a bit faster on the supermarket kiosks, to be honest. But anywho, they've made a significant investment in the baking facilities at Enfield, leading to improved baking yields. Okay. Like-for-like sales growth up 1%. Franchisee total turnover up nearly 10%. 17 shops opened in new towns or cities. They're expanding geographically. Also shows that they're having more shops in existing towns. So some towns can probably support more than one store. You know, I imagine like London and Birmingham could have a lot more than one store. So the board is optimistic about the future. They remain mindful of ongoing economic challenges in the trading environment with inflation, but inflation is starting to soften in some areas, which will support margin progression over the medium term. They continue to expand geographically, and they've opened 3 since the period of March 2023. They've increased investment in marketing via strengthened marketing teams, grow brand awareness, and expand digital and e-commerce capabilities. That's good. From the CEO, during the year, we've continued to innovate to meet the needs of our customers, worked on improving our operational infrastructure despite facing a unique set of macroeconomic pressures, and continue to grow sales and margins. We are looking at new ways to reach customers, and the new website offers many new marketing opportunities. We have continued with our steady store opening program to add to the 205 Cakebox stores we had at the year end. As we approach the 250 target new stores we set ourselves as a goal almost 5 years ago to the day, we continue to look to stretch ourselves with a new target of 400 stores and new ways to provide UK consumers with our unique egg-free fresh cream cakes. So that's good. They got a new store count of 400 target count. In a previous video, I've talked about how they could have potentially thousands of stores in the UK, but I guess a lot of companies don't want to stretch themselves too much. 400 is probably a very conservative target, but that's the target they've got. The chairman's statement. I'm not going to go through this actually. Finding our strategy. Yeah, e-commerce. They want to focus on e-commerce, which is good. It's quite tricky. I've just started doing e-commerce. Got a couple of brands I'm working with doing e-commerce, and there's lots of fluctuations with e-commerce. So it's not the easiest of things, but I don't think many cake companies are doing e-commerce. So I think they've probably got a head start there. So this is, I can't remember them saying that they had objectives for the year. So in the previous videos, they may have done previous annual updates. It's quite good that they've got them here. So let's go through them. The first objective for Cakebox is to expand the store estate and franchise growth. So they've opened 20 stores and 6 kiosks, but they want to reach more customers with a new stretch target of 400 stores. Yeah. Okay, fine. Focus on operational excellence. As they grow the store estate, they recognize the need to continue to strengthen operational discipline. This will underpin our ability to grow substantially. They want to fine tune cost controls. They want to secure improved supplier terms. I guess with they have that. Once they get more franchisees, they have a bit more flexibility in their terms because they're buying in bigger orders and whatnot. Baking processes, enhancing operational standards, hygiene, safety, and service, etc. Number 3, this is something that ticks my boxes because this is the business that I'm in: data-driven marketing and multi-channel expansion. They're going to refine strategy and stay ahead of the competition. They're going to adopt a data-driven approach, recognizing the importance of e-commerce and its potential to drive growth. Online sales have been progressing well, and we aim to become a fully integrated multi-channel business in the next few years. It's good. It's kind of where they should be, to be honest. By leveraging data provided by our franchisees, we target regions with limited Cakebox presence, ensuring a sophisticated and strategic store rollout that maximizes growth opportunities. I think this is quite important because they can actually, they could potentially be targeting, a bigger region with e-commerce, maybe, 20 miles or whatever. And if you've got 400 stores and you've got a 20-mile radius, then you're probably covering a lot of the country. And it can actually show what happens when you do e-commerce marketing is you can see where people live, because it obviously when you're booking something, you need to have a delivery address. So that means that the Cakebox team will be able to plot on a map where their customers are ordering from, which will give them unique data to be able to plot new store expansion, because at the moment they're all in retail stores, so they don't get that. When you buy a cake in Cakebox, they don't ask for your address or anything like that. So, but they're going to get that from the e-commerce data. Strengthening leadership and governance. They're building a strong team, and they're going to commit to ECG. In a previous video, they talked about how they reduce their waste, which is great. They don't have any waste, which is really, really great. They kind of recycle it and they give it to other companies and whatnot. Fine. Okay. Let's dig into why. Let's see if we can find out a bit more about why results were down despite having, overcome some of the issues. Okay, revenue growth was 5.6 and total franchisee sales growth was 9.6, demonstrating continued appeal in this market. And they're talking about an exceptional set of circumstances that were faced in 2022. They've confidently emerged from the pandemic, but then they encountered the combination of rising energy prices, raw materials inflation, and increased living costs for customers. And they say this was a unique cocktail of interlinked macroeconomic pressures that made some growth hard to come by. Alongside this pent-up demand for holidays from the pandemic took customers away from our stores, and a 9-week-long heat wave over the summer of 2022 created a difficult trading environment for a business such as ours. Despite these headwinds, we were able to again grow sales and grow margins, supported by shrewd purchasing decisions. We strengthened their team. They took advantage of volatility in the prices of commodities and essential products, and as a result, been able to be highly selective with any price increases that they're passing on to customers. This has been supported by our renting a bulk storage facility to maintain continuity of supply. And the 27,000 square feet premises is a stone's throw from our Enfield site in northeast London, and it's given us greater purchasing power. That's the phrase I was looking for earlier. As they grow, their purchasing power means that they can demand better terms when they're negotiating with suppliers. As ever, we aim to improve and expand our customer offering so that more people can experience Cakebox products and build our relationship with our brand. We've made great strides in that respect this year, with our franchisees selling 1.45 million cakes and 2.89 million slices worth 43 million and 10 million respectively. That's kind of an interesting number because 1.5 million cakes, like that represents quite a lot of birthdays and celebrations. That I think I don't know how many people live in the UK. Is it 70 million now? 60, 70 million, something like that. Means they've got opportunities to grow, but that's a number worth paying attention to. I wonder what that number is going to look like in 10 years from now. I wonder if it's going to go up to 3, 4, 5, 6, 7 million cases. I don't know. It's interesting. I think it will grow, but let's see. To complement this core approach, they've been expanding and looking at new ways to reach customers. Our marketing team has been working on a new website, which went live in June. And they're looking at customer experience. Franchisee sales have already risen from 13.3 to 13.8, or 20% of total franchisee store sales, and we are optimistic this figure will continue to grow on the back of a new website and increasingly sophisticated digital marketing. Okay, fine. We still haven't got to why things were a problem. Well, what they're going to do in terms of the summer season, they're promoting a range of mango products, mango cake, mango cheesecakes and slices, etc. Okay, that's fine. Mango cheesecake does sound really nice. So that's going to be live soon. So let's look at this. So they said that EBITDA went down. Actually, let's go through it. Revenue was up, which is good. Obviously, they've had a lot, many more stores. So they've had 10% more stores, but an increase of only 5.6 year on year. Presumably that means because like stores weren't rolled out, it wasn't 20 at the start of the year, they were rolled out throughout the year. Gross margin has dipped because of inflation and the cost of raw materials going up. But they're saying that input prices have stabilized and they're able to pass some prices to franchisees. And it hasn't hit sales, which is good. So maybe next year, gross margin will be more closer to what it was. EBITDA fell a lot as a result of planned increase in overheads and lower than anticipated revenue growth. Okay, adjusted EBITDA was 16% lower, not 24%. Cash has gone up significantly. So cash at the end of the year is 7.4 million. The group's only debts are mortgages of 1.3 million, secured by its freehold properties in Enfield, Bradford, and Coventry, 3 different places in the UK. The group operates a franchise model and therefore has a relatively low and flexible cost base. The board is therefore very comfortable with the group's cash levels and liquidity despite the unprecedented events of the last 3 years. It's talking about COVID and now the recovery with cost of living, inflation, blah, blah, blah. Property, they've had their properties revalued. They've gone up 200,000, blah, blah, blah. They've leased this massive expansion warehouse in Enfield to support the business expansion. That's good news. The tax rate was slightly higher. And it's just because of capital allowances. Fine. Earnings per share was lower. But good news is they don't increase the number of shares every year. It's 40 million in the last 5 years. A lot of growth companies start issuing loads of shares. And that is something they might do in the future, but it is dilutive. What does that mean? It means it dilutes everyone else's shareholding. And it means that it reduces the value of your shares, essentially. Unless you keep buying shares. Sometimes directors do give each other loads and loads of shares, and I'm glad that Cakebox hasn't started doing that. So that's like super positive. A lot of companies do that, so that's good. Dividend has gone up. It's a progressive dividend policy, and they've written it right here. That means it is going to go up even in a year where some of the metrics are slightly down. The dividend is up, bringing the total dividend to 8 pence for the year. That is really fantastic. I mean, 5 years ago, it was like a pence or 2. So it's really, it's really grown. Okay. So you get 1/3 at the start of the year, and then you get a 2/3 bonus, if you like, at the end of the year. Cash position, cash is, very good. Net cash of 6.1 million. Net cash is calculated with 7.4 less the 1.3 of mortgage debt. Trade, blah, blah, blah. That's static, same as last year. Trade and other payables has an increase because of cost pressures, it looks like. But I had a look at this. Admin expenses has gone up quite a bit since last year, nearly 3 million. They have increased their headcount, so that could be part of that. What else has changed? Profits have gone down. Cost of sales has gone up 500,000 as well. So we've had admin costs have gone up like 2.8 million, and cost of sales has gone up 500K. So that's 3.3 million. If we look at the profit before income tax or operating profit, let's say, if you add 3.3 million on, you get to, 9 million. So that would be an increase there. So maybe, maybe some of those costs get factored in, and the profit returns next year. Also, they've revalued the freeholds. That looks like it's gone down slightly. Okay, so let's look at another deeper dive. On the assets front, I think things are going quite well. So another thing that companies sometimes do is they really ramp up their intangible assets on their balance sheet. So it looks like, that nothing can go wrong, and then they're worth loads of money and blah, blah, blah. But like intangible assets are typically like, the value of the brands. So I think what Cakebox are doing here is they're not overly valuing that. They've got it at 400K. I think Cakebox is worth more than that, but they're not ramping that intangible assets on the balance sheet, which is, I think, it's another show of strength, in my book, that they're not doing that. That's really good. Property has gone up. Their property, plant and equipment is good. They've got 11.2 million of assets there, which is good. They also loan to franchisees. It's like a deferred tax credit or something. Sorry, no, that's a loan to franchisees. I think this is good as well. They support franchisees in fallow periods or in when they need to at the start. I think that's another thing that stands them out from other franchise companies. I don't know if all franchise companies do that, but Suk, the CEO, has talked about Cakebox being a family, and that's what you do. You help out your family members. So that's what he's doing. I think it's lovely what he's doing. Okay, inventories have gone up slightly. Cash, you can see, has gone up as well. Issued share capital remains the same, which we talked about earlier. Retained earnings, short-term borrowings, they're really not borrowing at all, really. They have some borrowings, but for a company of this size, they're doing very well. So we go into a bit more here. What's increased? Increase in trade and other payables is slightly higher. They've purchased property as well. 8 or 9,000 or something like that of property that they've purchased in the year. Obviously, dividends has gone up as well. So that comes out. So overall, one second, see if I can, might need to zoom out a bit here. Can't see what's on the side here. But overall, I'm not particularly concerned. There was 9 weeks of summer of a heat wave for a cake company is probably not a good thing. This is quite interesting segment reporting. So franchise packages, that was a part that you'd expect to be quite high. It actually went down because they sold less franchisee packages this year. So last year it's 3.7. So that's another million right there, and pretty much a lot of that is going to be profit. So that's kind of interesting. Sales of sponge went up, food went up, cream went up, other goods went up, online sales commission went up. But that's kind of interesting. There's nearly $1 million there of franchise package sales. So that's another $1 million that could probably be, I don't know what kind of profit margin that would be. I'd be surprised if it was less than 60%. So that's like well over $500,000 that would have been added to the profit as well. So I'm not concerned about that. Here's what I talked about earlier with wages. Wages have gone up 800,000. Traveling and entertaining has gone up quite a bit as well. Supplier costs have gone up quite a lot. Professional costs, I'm not sure what that is, but that's up 900,000. So there's quite a few things. You would hope that the professional costs are maybe one-off. Maybe they're to do with like, the new property purchases and things like that. Maybe it's could be to do with the website, maybe. But obviously the wages are going to continue, I would imagine. But those professional costs, hopefully they're a one-off. That's $1 million right there. Travel and entertainment, I don't think it's such a big line item, to be honest. But certainly the professional costs look quite high. Dum, 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 dum. But overall, I'm not particularly concerned with this. I think I was slightly surprised that the earnings were down by that much. But I suppose it has been a very exceptional year with the 9 weeks of summer and with inflation, and there's been a huge cost of living crisis in the UK. Most people haven't fixed their mortgages for a long period of time, like myself. Most people haven't moved, or maybe couldn't move, or didn't want to move to a cheaper area, like myself. So vast majority of people are coming across, higher cost of living, mortgage crisis, a squeeze on their earnings. So those factors did play a part. Let's look at this. The management have dividends. They don't have huge salaries, which again is very, very good. When you get to be a growth company, a lot of the directors take ridiculous salaries, and I think it's very fair, the salaries they're taking, to be honest. The dividends are good as well. Like Suk is the CEO, he obviously gets paid very well in dividends. That's completely fine. And the other directors are getting something from dividends. The owners have own stores as well, which is fantastic. Suk owns 4 stores, and Jaswir Singh, he's on the board as well. I'm not quite sure which position he's in, but him and his family own 7 stores as well, which is very good. It shows that they have skin in the game, family of franchisees, etc. So I think that's very good. They have some small borrowings related to mortgages, not a big problem. Trade and all that goes in, that gets cycled through the year, so it's not a big deal. They've got some trade receivables as well. That's probably what the franchisees owe. So yeah, I'm not too concerned about all of this. Let me know if I've missed anything. I don't think I have. That's the whole document. I'm going to talk about my thoughts now. Actually, first, let's look at the intangibles, because this is kind of what I said about intangibles. So they're listing website, software, and the ERP system. Again, I don't think they're going mad on the intangibles. I think that's kind of all fine. Yeah, I don't think they're doing anything untoward. I know some other bloggers found something a few years ago which they thought was untoward. I don't think they are. I'm a long-term investor anyway. But my initial view was that it was a shame that EBITDA fell, and adjusted EBITDA and profits fell. But as we can see, a lot of things cause that. You have professional fees, you have the lack of sales for the year because of, if you look at it as a like for like weighted, if you've got another 10% of stores, revenue should be at least 10% higher. However, they're all through the year, and they're kind of open throughout the year in periods that's not a full year, and also the 9-week summer, the cost of living, the inflation, blah blah blah, has meant that it hasn't been a normal year. But let's think about it in terms of other businesses. If you were looking at investing in lots of other companies around the world, which as investors I'm sure we are, some companies don't get impacted by summer as much, and that's something to consider. I personally believe in the Cakebox story. I love the cakes. I think they're very light and fluffy, and I think they're here to stay. I think they're selling millions of cakes. 1.5 million cakes is a great number to be selling every year, and it just shows you a kind of resilience. What else do I think they can be doing? I think they can be expanding quicker. I think they could be looking at opening up in more supermarket kiosks. That they could be thinking about other supermarkets. I think they could be rolling that out a bit quicker. Maybe even having a dedicated resource for that, a partnership resource who manages the rollout of kiosks. I think that would be good. I think having some purely vegan products, I think that would be good, although they don't necessarily need it, and they're already selling lots of cakes. I wonder if they can do more in terms of the summer offering. Can they do something that's even lighter? Cheesecakes are still quite heavy. I don't know if they can do something, I don't know, maybe a vegan ice cream stand or something like that. That might be quite interesting. I don't know. But in terms of investing in other companies, I think that Cakebox is still a very good buy. It's about 139 pence. It's gone up a little bit, I believe, in recent months, certainly weeks. The dividend is pretty strong at 8 pence. So you're getting well above 5%. I don't know what I don't know. I can't work it out in my head. It's probably something like 7% or something at the moment. As I mentioned in previous videos, I think the dividend is going to go up every year. They talk about a progressive dividend policy. If you looked at those directors, they're not earning a lot from their dividends at the moment. But, if the dividend doubles, triples, quadruples, all of them will earn more. And that's what they want to see. And that's what investors want to see as well. So I think it's a really strong dividend kind of perspective. I think when you invest in a company like Cakebox, I think it's important to have a very long-term view, because they only have 200 stores, right? It's good, but it's only 200 stores. And you really start to see growth when they start rolling out sophisticated marketing. Domino's Pizza really grew with TV ads, and I don't think Cakebox is there yet to do TV ads, because they don't have the geographic coverage to do. Once they get to maybe 500 stores, they can start, maybe 400 stores, they can start thinking about doing TV ads. They should be doing YouTube ads, and they should be doing online marketing more. I've always been surprised that they haven't. Nevertheless, I think they're going to go in that direction with the marketing director. So I think that's exciting. And international, they haven't thought about. I suppose they want to conquer the UK before looking at international. I don't see why they can't start thinking about international soon. I do think that's going to come on the cards in the next 5 to 10 years. If it were me, I'd be thinking about it already. Cake's cake. If people in the UK like cake, I'm sure people in Europe and America and other countries like cake. Why can't they think about growing internationally? I know it's maybe they don't want to do it just yet. They probably want to get to 400 or 500 stores in the UK before they start thinking about that. But I think there's a lot of growth there. So I think when one's considering about investing in a company like Cakebox, they're not really looking at it year on year. It's nice to look at it year on year, but what happens is in a year like 2022, you see there's some variations, and that's why if you look at it over a longer period, 3, 4, 5 years, if you look at the business metrics, not the share price, but if you look at the business metrics, you can see they've gone from, I don't know how many stores they had, 40, 50 to like 200. Dividends gone from 1 or 2 pence to like 8 pence. And they've built on an e-commerce. They're building an e-commerce brand. They've got online sales. They've got delivery. They've become and then maturing into a national brand, and a brand that is going to smash the competition. Really, I mean the competition has like 20 stores or whatever, so I don't see them as competition at all. So I still like Cakebox. What's going to happen to the share price? Don't know. I think ideally the share price would reflect the growth of the company. So once the company starts to grow EBITDA and earnings and whatnot more favorably in the coming years, hopefully you would have more earnings, and the share price would reflect that. Something just came to mind actually that I think they could try. They probably won't try this, but I wonder if they tried like a cafe concept, increasing their store size by like 20-30% and having a few tables and chairs and serving coffee and hot chocolate and things like that. I think that could be really interesting for the winter. If you had kind of vegan or vegetarian or vegan hot chocolates, I think that would be a really interesting offering. And I think for that passing trade, I think that could be really good. If they choose to do this, you've heard it here first, right? I've talked about it in 2023. I did recommend delivery to them on one of their share calls in 2019 or 2020, I think it was 2019 maybe, and they started to do that. So I don't know if they're listening to me or if they're probably just bouncing around their ideas in the board meetings. But yeah, I think a cafe concept, I think they could try that. Maybe certainly in the kiosks, or if they do something like a what's it called, a service station on the motorway, you can have like Cakebox, have a slice of cake and have a hot chocolate with it. I think that would be, or coffee with it. I think that could be interesting. Guys, I've mentioned loads on this video. Let me know what you think. Do you think that Cakebox is a long-term buy? Do you think you should have long-term perspective, or would you think about selling it even? My views. I'd love to hear your comments in the section below. I do videos on all sorts of types of investing, from equities to startups to property. Let me know what you want to see more of in the comment section below. Remember, knowledge is power, especially the right kind of knowledge, and progress is everything. And there'll be some other videos that you might be interested in watching around on the screen now. Take care, guys. Cheers.